Hello, fellow Rebel Capitals. Hope you're well. So we've got the reverse repo account with the Federal Reserve is almost dry. What does that mean for liquidity? What does that mean for the bank reserves? What does that mean for the U.S. economy? What does that mean for the stock market? These are all questions that we have to answer right now on this video. We're also going to talk about an investment that I think is going to be an amazing opportunity. That's going to be at the end of this video, and kind of sandwiched in between, we're going to talk about McDonald's and what they are saying about the U.S. consumer, and therefore what they're saying about the U.S. economy. So first and foremost, before we get into it, guys, I want to remind everyone that I just set up a brand new interview channel, Rebel Capital's Interviews. The link is right there in the chat. Josh, do me a favor and put that in the description as well. And on that note, I think we're going to publish our first interview tomorrow, and that will be with the one and only Jeff Snyder. But let's get right into it, guys, as far as what's happening with the reverse repo account at the Fed and what that means for liquidity, because a lot of experts out there are pointing to this and saying, oh my gosh, we're getting so low now that the Fed is going to have to stop QT and they're going to have to start doing QE because there's just not going to be enough bank reserves in the system or enough quote unquote liquidity. All right, so to see what is happening, the details, let's go right over to the Fed's website, the Fed. Josh, did you notice they did like a makeover here on the charts? Did you notice that? They kind of give them a fresher look. We'll have to give them credit where credit is due here. But same data, but just different kind of style with the charts. They look a little more modern, I guess. But the bottom line is the reverse repo account was up at 2.3 trillion. 2.3 trillion in April of 2023. And we've gone straight down to a point where now, as we speak, we're right around 95 billion. So you could argue we're getting into that danger zone, because what happens with, and here's the argument here from the quote unquote experts. They say you have all this cash that's just sitting on the Fed's balance sheet, and that cash is that 2.3 trillion is available to go ahead and buy US government debt. So if the interest rates get a little higher than what they can get in this reverse repo account, what's it going to incentivize the money market fund managers to go out and buy those treasuries? Because let's just say this is paying whatever 4.25%, or if you get 4.5 on a 3-month T-bill, well, you're going to take the 3-month T-bill, right? So they're saying that a lot of the demand for treasuries is coming as a result of this cash coming out of the reverse repo account. So if this is running dry to the point where it goes down to almost zero or effectively zero, then are we going to see interest rates, treasury yields, spike higher because now there's no more demand, because there's no more balance sheet capacity, there's no more cash, because that cash, that 2.3 trillion, has already been deployed. And what does that mean for liquidity in terms of bank reserves? Because a lot of the experts out there say that the balance sheets of the banks are constrained if they don't have enough bank reserves. That's where the liquidity component comes in. So if the Fed gives them more bank reserves, then they have more balance sheet capacity, then they can go ahead and lend into the real economy, or they can lend to one another. But if you're constraining that balance sheet capacity, then you're constraining the ability of those banks to issue credit, not just interbank credit, but into the real economy. And how does that play out, especially with asset prices, when all these hedge funds have borrowed a lot from those banks in order to buy stocks, financial assets, etc. So this is the argument that everything revolves around the Fed's balance sheet. So now let's go over to, well, speaking of the devil, the Fed's balance sheet, and you can see that we're down. It's not, it's still way up, but it's down from 8.9 trillion to where it is today, 6.8 trillion. So a lot of people would point to this and say, well, sooner or later, you're going to hit that line in the sand where the Fed has unwound too much. And therefore, they've sucked too much liquidity. In fact, you could play a drinking game with this video. You got to drink every single time I say liquidity. But the Fed has sucked out all this cash from the real economy. And at some point, they're going to have to reverse, because we saw what happened during September of 2019. You guys remember this. Remember when the repo rate spiked up to 10%, and the mainstream narrative was there just wasn't enough cash in the system. The banks didn't have any money to lend, and therefore the demand stayed the same. The interest rates went up because the supply of money went down. But in reality is probably something a little bit different. But you can't just look at the Fed's balance sheet, regardless of what your view is as to how important the Fed's balance sheet is. You've got to look at the key component of the Fed's balance sheet, which is bank reserves. So let's not just look at the overall, because this would include this decline of from QT would include not only the reserve accounts of the banks, but it would include the TGA, and it would include reverse repo. So now let's look at the total reserves, and you can see that it's kind of a nothing burger. We're pretty much flat going all the way back to 2022. So how does this work? Because if the Fed has done, let's say, $2 trillion in quantitative tightening, reduced the size of their balance sheet by $2 trillion, how on earth is it possible that the amount of bank reserves during that time pretty much flatline? Well, because you have, let's say, bank reserves going from, or cash from the TGA into the reserve accounts of the banks, because Janet Yellen is spending that money out of the real economy, and or you have the cash going from the reverse repo account into the reserve accounts from these banks that are liabilities of the Fed. So the argument there is, if the Fed continues to do QT and the reverse repo account is tapped out, then you've got the TGA going down as well. Let's say we have another debt ceiling crisis or whatever it is. Then the actual reserve amounts from the banks are going to go down if the Fed continues QT, and that's going to cause a big problem, because now you're restricting you're reducing the balance sheet capacity of those banks, in addition to all the other things that would be net negative for liquidity that we talked about at the beginning of this video, such as there being no more cash to buy T-bills, as an example, because that 2.3 trillion, let's go back to that so we're on the same page here, that 2.3 trillion is now bone dry. All that gunpowder, or all that dry powder, has been utilized. So if you're someone that sees the Fed's balance sheet as the center of the monetary solar system, and therefore the center of global dollar liquidity, go ahead and drink again, then this would be a big problem. This would be a very big problem. And I can see how you would come to the conclusion that if we continue on this path, the Fed is going to have to go back to QE very quickly, even if everything else in the economy remains the exact same. Now, I have a completely different view. Most of you know that I don't think the Fed's balance sheet is at the center of the monetary solar system. I think it's the commercial banks themselves. And whatever's happening here with bank reserves, I don't think it makes one bit of difference to the banks, other than obviously the Fed can bail out banks where then the bank reserves matter, for sure. But the other 99% of the time, when the Fed isn't bailing them out, whether there's 1.5 trillion in here or 3.3 trillion, it doesn't even phase the banks. This is not part of their decision-making process. And I was talking about this with Jeff Snyder today, where we were going through an example of what's happening in China. As you know, that real estate market is crashing. They're at the very least experiencing a balance sheet recession like we experienced during the dot-com bust in the United States. Well, you guys know that that's going to impact the local Chinese banks. Okay, it's going to increase the risk there. It could blow a hole in their balance sheet. They're going to be less willing to lend into the real economy. And that's why you see Chinese government debt, the yields going down to all-time lows, because those banks are trying to find anything that's safe and liquid that they can put in their balance sheet, as opposed to lending into the real economy where there's way too much risk. Therefore, the risk reward doesn't make sense. But then we zoomed out a little bit and said, okay, well, do the Eurodollar banks that are outside of the purview of the ECB, outside of the purview of the BOJ, outside of the purview of the Federal Reserve, do these banks have any exposure to the Chinese banks? And the answer is yes, because they provided a lot of dollar liquidity to them. So if the real estate market is having an issue, the Chinese banks are having an issue, which increases the risk for the global dealer banks that are in this Eurodollar system. Okay, well, then what does that mean? Then that Japanese bank that's going to need that dollar liquidity is going to have to likely pay a higher rate, because the global dealer bank is managing their entire balance sheet, and that balance sheet includes borrowers from China, from Japan, from the United States, from Canada, from Australia, India, etc. So if something's happening in China, then that increases the risk profile for their balance sheet, and the Japanese bank is going to have to pay the price for that, most likely, with having to have more collateral or having to pay a higher price for that debt. Well, what is that going to make the Japanese bank do? They're going to have to go further out the risk curve because their dollar funding costs go up. Well, at a certain point, they're not going to be able to get the return by buying, let's just say, a CLO in the United States. And they're going to say, okay, we can't take the loan. And therefore, that massively reduces that bank's willingness, not ability, but willingness to lend into their local economy. So the reason I'm going over this here is to illustrate how we've talked about all this dollar liquidity going from China to global dealer bank to Japan to the United States, blah, 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 blah. And I didn't once, not even once, mention bank reserves, nor did I mention the Fed's balance sheet. Because pretty much every single one of those transactions we were talking about has nothing to do with the Fed's balance sheet. They're creating that credit, and they're settling those transactions amongst one another without accessing. Those transactions are not settled on the Fed's balance sheet because a lot of those banks that are involved don't have a pipe that goes to the Fed's balance sheet. In other words, an account. And therefore, it's very cumbersome for them to do this, very costly. And therefore, instead of settling with bank reserves, they're going to settle with dollar credit from one of these other banks that pretty much act in the exact same fashion. So again, I wanted to explain that, go through that thought experiment so you could see how this really doesn't impact anything 99% of the time. Because if you're looking for this to actually have to make a material difference, what you have to do is you have to ask yourself, how does this increase or decrease the risk in the monetary system? And usually these big ups and downs, if they're not bailing out a bank, don't have any material difference or don't make a material difference at all. And just as further backup there, and I know I talk about this all the time, but if you look at the bank reserves, let's zoom out here and max. Look at the amount of bank reserves in the system. It's flat going back to 1959. It's at 18 billion, and we go all the way to 2007. It's 43. So if bank reserves matter, if bank reserves equal liquidity, blah, 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 you explain this one to me. And by the way, this includes currency, or excuse me, this includes Vault Cash. So the Vault Cash is really what expanded the amount of reserves. And obviously, they're not using Vault Cash to settle in the Eurodollar system. They're just using, if anything, they're just using those electronic reserves, which pretty much were flat from You can even take it back to 1940, because 1940, I know this right off the top of my head, they had about 10 billion in electronic reserves. And then you fast forward to 2007, they had 10 billion in electronic reserves that could be used to settle, which could be used to create quote unquote liquidity. Go ahead and drink again. So this chart, I mean, shows you that the banks really don't need that at all. And we need to focus on their willingness to lend, their willingness to create dollar credit, their willingness in turn to create, loans, creating currency units denominated in dollars, not their ability. The Fed really has nothing to do with their ability to do so. Okay. Now let's get into McDonald's. We'll take it back home and focus exclusively on the domestic economy, because I think you guys are going to get a lot of insight from the boots on the ground intel that we're seeing from these mega corporations that are dealing directly with the American consumer, the average Joe and Jane. So right here, McDonald's revenue disappoints. U.S. sales see worst drop since pandemic. Now, it is true. A lot of this could be contributed to the E. coli outbreak they had. Why anyone eats at McDonald's, I don't know. But that's not for me to judge. But even McDonald's comes out and admits that you can't blame everything on that outbreak they had. A lot of this is because the U.S. consumer is just simply strapped. They're tapping out. McDonald's, there's key talking points. McDonald's quarterly earnings met expectations, but revenue fell short of Wall Street's estimates. The burger chain, and keep in mind, so the estimates obviously would have included that E. coli outbreak. That would have been baked into the cake. So even with that baked into the cake, they're still a lot lower. The burger chain's U.S. same-store sales declined as customers spent less at its restaurants. Both of McDonald's international divisions reported same-store sales growth. So again, this is a story that really revolves around the U.S. domestic consumer. So they go over details, earning per share, revenue. Okay, got that. I want to focus more on what they're seeing in the U.S. economy. They said traffic was slightly positive, but customers spent less than usual during the quarter. Over the summer, the chain rolled out a $5 combo meal to bring back price-conscious diners and reverse sluggish sales. The strategy worked, helping McDonald's U.S. same-store sales tick up in the third quarter. And by the way, that worked as far as gross revenue, but it probably didn't work for the bottom line for these individual franchisees, because they were, selling those $5 combo meals at a loss. It works for the franchisor, doesn't work for the franchisee, because the franchisor obviously is not earning their franchise fee on the net, they're earning it on the gross. They say, however, analysts have warned value meals only work if customers also add menu items that aren't discounted to their orders. Yep, there you go. So these $5 meals are a loss leader. So you can't just buy the $5 menu item. You've got to buy something else that actually has a margin, to where on net they're making money on that customer, that diner that's coming in. But what they're saying is that didn't happen. People are going in there and exclusively buying the $5 combo meal. McDonald's executives downplayed those concerns Monday. What concerns? I missed it. However, analysts have warned value meals only work if customers also add items that aren't discounted. Okay. McDonald's executives downplayed those concerns Monday, saying the average check on a $5 meal is about $10. Okay, but that doesn't tell me how much of the additional 5 is got margin. I mean, you could be selling other things that don't make much money. So I don't know if that tells us a lot. The biggest hit to McDonald's U.S. sales came in late October. This is when they're talking about the E. coli outbreak. Here we go. I think, and there's a quote from their CEO. I think right now what we're seeing is the E. coli impact is now just localized to the areas that had the biggest impact. So think about that as sort of Rocky Mountain. I guess that came out in Colorado. I didn't realize that. The company hopes value deals along with key menu additions will help to fuel recovery. In 2025, burger chain plans to bring back its popular snack wraps outside the US. Okay, we want to focus on US. Okay, now this is all international. Just scanning this, guys. Okay, so then this goes into the earnings per share and the international stuff. So what I wanted to focus on is what they're seeing domestically, which it seems like they took a hit with the E. coli. They started to see it pick back up, but even though it picked back up, they didn't see the top line sales because those people that were coming in for that $5 value menu, they weren't buying, $15 worth of stuff. They're only buying $10 worth of stuff. And again, I like to point out that the Wall Street analysts obviously were factoring in the E. coli thing into their estimates for earnings, which McDonald's disappointed on. So I think what you really have to do when you're trying to assess what's happening with the US economy is first and foremost completely ignore the stock market, because there's almost an inverse relationship between the stock market and the US economy. Although if the stock market tanks, then the economy is going to tank as well, because you guys know as well as I do, the US economy is pretty much propped up by these asset prices. It's a bubble economy, as my good buddy Peter Schiff says, and I could not agree with him more. So you've got to look at these things. You've got to compartmentalize them, right? And then once you do, you look at the economy and say, okay, what data points do I have here? And I talked about this with Jeff as well. We've got GDP, real GDP, 3%, not bad. We've got unemployment rate, low, not bad. But then once you look beneath the hood, you see with that unemployment rate, we've got fewer people working. The labor force participation goes down, especially way under trend. If you look at the trend prior to the cerveza sickness, and then you look at the amount of hours are declining, and you look at other factors as far as GDP, and they might not look as hot, especially moving forward, knowing that we've got a lot of these revisions. I mean, look at the revisions we had in the establishment survey, right? Revised down, what was it, 550? Initially 818,000. So, could we see similar revisions of GDP? I don't know. We'll have to wait and see how all this stuff plays out. But in addition to those numbers and kind of weighing the good and the bad, which you're always going to have when you're looking at the real economy, I think you got to take a look at this anecdotal stuff. I don't think you can ignore it. And the anecdotal stuff I'm talking about is what's happening with McDonald's. What are you looking at from the car dealers? Well, look at Ford, look at Chevy, look at all these other things that I could point to that shows the economy is slowing. In fact, another thing I talked about with Snyder is low gas prices. I mean, sure, there's a supply side component of that, but the big component of that is demand. And that's showing you that demand is very, very low. And if demand is low for energy, I can assure you that the economy is not booming. And then, of course, just what's your own experience, right? What's your own experience in the labor market, which, by the way, is completely stagnant right now, just like the housing market. A stagnant market is not healthy, even if the unemployment rate is low or even if housing prices are high. Because if you do by chance lose your job, it's going to be very difficult to get another one. Right? And with the housing market, it makes things very fragile. If there's very few transactions going back and forth, you really don't have a market because it's just kind of frozen almost. And that's not what we want to see. So you've got to combine this with the GDP number being at 3%, with the unemployment rate being at 4%. and then with the anecdotal stuff, come to a conclusion as to what's really happening beneath the surface in the US economy, and therefore what's likely going to happen throughout the rest of 2025. And that's a tough analysis because we've got so many of these unknowns. Every single day I turn on the news, it's a different, thing from Trump. He wants to take over Gaza. He wants to do the tariffs. I think he just came out with more tariffs on, was it steel today? And at the end of the day, that could impact things. You never know how these the unintended consequences, right? I mean, Trump can be the smartest guy on the planet Earth and have a great advisory team, but you really don't know what a 25% tariff on Mexico, how that's going to play out in the global economy. It could play out the exact way you think, and it could have some unintended consequence that was not on your bingo card. And usually it's the latter. So bottom line, got a lot of uncertainties, but when you're doing your analysis, make sure you pay special attention to the anecdotal evidence and what you're hearing from the actual consumer, such as in the Michigan survey, University of Michigan, and a lot of these other surveys where they talk to the real people, the average Joe and Jane directly. Now let's go in. Oh, the huge investment opportunity. This is something I'm super excited to share with you guys because it's something I've been talking about since 2020, and it's played out. It's played out very well, but I think there's still a lot of upside in this because I believe we're in this super cycle. It's going to last a long time, although nothing goes up in a straight line. It's always a roller coaster ride, as you guys know. And one of the main reasons I loved this asset back in 2020 is because everybody hated it. Everybody hated it, and everybody still hates it. But a lot of times, that's where you get the best returns, or that's where you have at least the best asymmetry in buying things that everyone hates. I remember reading Hot Commodities from Jim Rogers. If you guys have read that book, remember what his favorite commodity was back in the early 2000s? It was lead. Lead. Talk about something that's hated. And what happened to the lead price? In fact, just for fun, let's pull up a chart of the lead price. You guys will get a kick out of this. I think they've got a good one. Let's see, trading economics. And there we go. So here's where Jim Rogers comes out with his book. Talk about a good call. Right around here. I think it came out 2002, 2003. And his argument was that, yes, demand for lead, for obvious reasons, is, it's persona non grata, it's poisoning the kids, it's doing all these things. Yes, the demand is going to go down in the United States, but the demand is going to explode in all of the emerging markets because you still need lead in components, not necessarily paint, but you need it in batteries, like car batteries, is I think the specific example that Jim used. And you've got supply going down because no one in their right mind would invest in bringing more lead capacity online, right? Because again, it's persona non grata. So you see the supply side tank, while at the same time, demand in the United States tanks, but demand globally actually stays the same, if not increases, which you get this parabolic move where the price of lead goes from, let's just call it, when Jimmy Rogers, when his book came out, it was around 500, and then it goes straight up to 3,500. Not bad. Not bad. So the punchline is, I think today's lead is coal. And I've talked about this a lot. And I think what I'm going to do is a webinar in Rebel Capitalist Pro this Friday. Josh, let's do 5 p.m. Eastern time. And if you guys want to participate in that, you can just go to georgegammon.com/pro. You can do just a $1 trial, and then you will have access to the forum. You'll have access to this webinar where I'll go over with Rebel Capitalist Pro members kind of my strategy moving forward within not just the commodity space, but coal more specifically. For those of you who don't know, I partner with Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Sresna, Jason Hartman. And Chris McIntosh has been talking about coal for as long as I've known him. And he was the one that actually turned me on to coal back in March of 2020. But the great thing about Chris is, see, I look at it from a 30,000 foot level, and I can just tell you the reasons I like the commodity. But Chris actually gets into the nitty gritty and analyzes the companies within the space. So this is what I want to do in the webinar on Friday, is not just go over my bull thesis and why. We'll go over the supply stuff, the demand stuff, but then also I want to go over some of the specific companies that Chris has been talking about and give you really some actionable advice. So you guys aren't going to want to miss that. You want to go to georgegammon.com/pro and sign up for that ASAP so you can take part of that, or take part in that live stream. And if you don't make it live, obviously you'll have access to the link when you can watch it over the weekend at your own convenience. But let's get into some of the more broader stuff about the commodity space and therefore coal. I want to pull up a chart of the commodity super cycles. And these are always really interesting. I know the Visual Capitalist has one that I use a lot. In fact, I use this a lot as well. And I know this chart is featured on a lot of my whiteboards. Oh, good. And we can zoom in here. So this goes back to, what is it? Maybe it's prior to the cerveza sickness. So their projections are that by, call it 2030. Well, that's just their, dang it. That's their short-term projection here. It looks like going into 2030, but their long-term projection is by 2045 is that we go way higher, way higher on commodities. And the rationale they're giving is because each peak is higher than the one prior. I don't know if I'd put a lot of weight into that in and of itself, but you can see how these things move in cycles. And I can almost assure you, whoops, camera's over here. I can almost assure you the bottom in commodities was probably April or May when the price of oil got into negative. You guys remember that well, I'm sure. Negative $38 a barrel. So although you couldn't have bought it for negative $38 a barrel, you still could have bought these producers. Let's just say Chevron or Exxon as an example. You could have bought Exxon back when oil was trading at under $20, right? And think about how much money you would have made on that. Not only would you have been paid probably a 10+% dividend, but you would have seen the value of what you own as far as the individual company go up tremendously. In fact, let's look at a chart of Exxon, just using that as a proxy. And keep in mind, what's great about Chris and Rebel Capitalist Pro is he's not just giving you names like Exxon. He's giving you the much smaller companies within the space that have much more upside potential. And the space I'm talking about, again, coal. So let's go back. Here's March of 2020, where you could have bought it at 32. And now it's up to 110, which is an increase of 82%. But keep in mind, during that time when it's going up by 82%, the dividend yield currently at 110 is 3.57. So if you would have bought, let's just say, down at 30, $35, obviously your dividend yield would have been much higher now because your cost basis was so much lower. In fact, I wonder what well, we can do that math later. But the bottom line is this is probably the least amount of money that you would have made in the space. If you would have got into the smaller companies, and if you knew what you're doing with the balance sheet and analyzing the management and all this stuff that Chris does extremely well, Lynn does as well, you would have a lot more upside potential. And at the end of the day, what we're looking for as investors is we're looking for asymmetry. Asymmetry. We're looking for an edge. We got to have that risk management. We got to have asymmetry. Now let's go over and look at a price, the price of coal. I actually haven't looked at this lately. And by the way, I'm going to get to CNBC because they actually did an article on this today, which is what gave me the idea to include this in the video. So trading economics, probably the best. Ooh, look at that. That's good. Ooh, that is very, very good. So back in 2020, I always used that as like where it was definitely cheap for sure. This is April. That's when oil was down negative, and coal at that time was 42 bucks. And it is 107 now. But keep in mind, this is a nominal chart. And when I'm looking at commodities, just me personally, I always try to figure out, okay, what's it doing in nominal terms? But maybe more importantly, what's it doing in real terms? That's when I know if historically it's cheap or based on its historic price, whether it's cheap or expensive currently. So let's just assume compounded the inflation rate or prices since May of 2020 have gone up by, let's just say 30%, 40%. So that would mean that inflation adjusted, comparing apples to apples here, this 107 would be it wouldn't be down at the same levels, but it would be much closer to the levels we saw. And actually, I wasn't doing that right because I didn't have my pointer right on it. So right around 54 bucks, excuse me. So when you adjust for inflation, that 107, comparing apples to apples, what we saw back in 2020 would be, I'm just ballparking it here, maybe 65 bucks, maybe 70 bucks. So you can buy coal right now, and I don't know about the producers, but just the commodity itself for very close to what you could have bought during the cerveza sickness. That's good news. That's what I want to see. And you say, well, how can the price be that low? Well, you had this huge increase, which probably brought a lot of supply online. That was due to Russia invading Ukraine, among many other things. The Germans weren't prepared for it, so they didn't have access to the nuclear that they should have had. So they had to go to coal, and you guys know the story. But since that, then I'm sure you had a lot of supply come online. And then the price tanked because when the prices go up, that reduces the demand. You have the supply come online. And then you have the projections for demand going down as well because of a global slowdown. And that's what brings you to the price that we have today, which I think is a great opportunity. And that's what I'm going to be discussing more on Friday during that webinar for Repo Capitalist Pro. Now let's get over to this CNBC article, which I think really highlights my fundamental argument for coal longer term outside of the fact that I think we're in this commodity super cycle. World isn't close to breaking free from coal. In some countries, demand is surging. Key talking points. U.S. exports of coal have been rising steadily to satisfy growing global demand, the world's dirtiest fossil fuel, even though its domestic consumption has decreased. So what was Jim Rogers telling us about lead in the early 2000s? Yes, he said, the demand is decreasing in the United States and maybe the developed world, but it's increasing even more than it's decreasing in these other countries. It's increasing more in these other countries than it's decreasing in, let's just say, the West. But the key component is you're not going to have any investment in future supply. So that means supply going down, demand, even if it stays the same, price has one way to go. They say the global shift away from coal remains challenging, largely driven by rising demand in Asia, I would say all emerging markets, as Europe and the United States see significant declines. This is according to Dorothy May, project manager for Global Energy Monitor's Global Coal Mine Tracker. That's a mouthful. All right. So Trump here, he says, no one can destroy coal. Said that at the World Economic Forum. I would agree with him on that one. So let's go down here to the punchline where you can see world coal consumption. Now, it did flatline here, but then what happens after the cerveza sickness is all these global supply chains break down. Like, oh, we can't really rely on wind and solar as much as we thought we could. And we've got to start using more coal, whether we like it or not, because we don't have access to, let's just say, Russian nat gas, et cetera, et cetera. So you see the consumption of coal increase in the United States as well, in the EU, as you would imagine, in India, and then China. It's ironically, it's flatlining in China, while in the developed world, it's really kind of, I'm not saying booming, but it's going up at a much faster clip. And again, my bullish thesis here isn't that demand for coal is going to explode. It's that demand for coal is going to stay relatively the same because of these cross currents, where one country it's going down, where other developing countries it's going up. But supply investment into coal. Just think about going to Goldman Sachs or JP Morgan or one of these kind of woke corporations and saying, yeah, I want to go ahead and borrow $1 billion to mine coal. They're going to tell you to get lost. They don't want anything to do with you. And you're not going to be invited back to one of their cocktail parties. You're going to be persona non grata, like we were saying earlier. So you just don't have any money going into more supply. And when supply is going like this, demand just flatlining. Again, you guys know what happens to the price. So they talk about one of these emerging markets. They talk about China wanting to hoard as much coal as they possibly can, because although they're trying to transfer or transition into more friendly green energy, at the end of the day, they need this as a backup so they don't have any downtime. Energy is the economy. And if the wind isn't blowing or the sun isn't shining, you have to have the ability to utilize that energy source, which, by the way, you can transfer from one province to the other. One of the things they point out in this article, as far as a problem with wind and solar, is it's very difficult to transport it. So you could have the wind blowing in this province of China, but the wind's not blowing in this province, and you can't take that energy and just transfer it over very easily, or if at all. Where if you have coal over here and it's not being utilized, then what do? You put it on a truck, bring it over here, you're good to go. So it's all about that utility. The utility. That's crucial to think that one through. So India as well, focus on economic infrastructure development, has also boosted consumption of cement and steel. And by the way, remember that coal isn't just used for energy. It also goes into the production of steel, which is very important. And I can assure you, just living right here in Medellin, that steel is, and cement, is a huge, huge component of the growth. I mean, you just, every single day, or not every day, but every other week, I go down into certain areas of Medellin, and you just see buildings going up left and right, like nothing you've ever seen in the United States. The growth is staggering. And every single one of those buildings has a lot of steel and a lot of cement, therefore a lot of coal. They say beyond China and India, there's still more demand, positive demand developments. You got Bangladesh, Indonesia, Vietnam. I just kind of lump them all into developing or emerging markets. So again, you've got demand, even if it is going down in the West, which it's not based on what's happening in Europe. But even if it was, you have the demand increasing at a faster clip. So at the very least, it's going to offset the decline in demand from the more developed economies. The AI factor, they throw that in there as far as, I mean, we'll have to see how this plays out now with DeepSeek and whatnot. But prior to DeepSeek, it was common knowledge that the AI explosion would also require an explosion of energy, and that would include fossil fuels. Uh, no matter how much Greta Thunberg or whatever hates that, it is what it is. Will it still be possible? I'm sure it will be possible to transition, but we have to remember that we never, ever, ever use less of the last energy source. So I always use this chart. I don't know if I might be able to pull it up real quick here. What is it? It would be energy, historic energy source chart. I think this is another one from Visual Capitalist. I'll recognize it right away if I see it. Aha, there it is. And it's actually from Our World in Data. So this brown component, that's biomass, which is basically cow dung and like and like lumber. And then you've got coal. We transition from biofuels to coal to oil to nat gas to hydropower, wind and solar, all these things. But you'll notice that we never use less of what we were using. We just add more to the energy mix. And this is how the population grows. This is how the economy grows. And so my view is if this has happened throughout history, it's going to play out the exact same way. Even if we are adding wind, even if we are adding solar, that's great news, but it doesn't mean that we're going to be using less coal. We just have less investment going into coal. All right, guys. So to check out that webinar, go to georgegamma.com/pro. Again, you can sign up for a $1 trial, or you can stick around and remain a member. It's an incredible website. We've got back-end research from Lynn and Chris. We have these live streams with all the pros in there. It's an incredible resource that I think everyone needs in this tumultuous time we live in, and 2025 being the year of unknowns. You definitely want a North Star or kind of an investment compass. And that's exactly what Rebel Capital's Pro is. So on that bombshell, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. We'll see you in the next video.